Good morning, everybody, and welcome to this week's session of Expert Insight webinar with Estate Living. We are very, very pleased today to be talking about a topic that has come up over the last few months in various formats, and that is retirement funds. What is happening within the legislation? What is current changes, future changes, changes that are being discussed, and how will this affect yourself? Whether you are a South African who is looking to retire, a South African who's looking to emigrate and wants to use your retirement funds, or South African who wants to access your retirement funds early. So because this topic has come up quite a lot with us, we went out on the search to find the expert that can talk to us around retirement funds. And we're very, very pleased today to have Keith Peters with us, who's from Old Mutual. But before we introduce Keith, let me just quickly run through a little bit of housekeeping with you. So the wonderful thing about these webinars is it enables us to ask questions. I have received a number of questions from those of you who registered, and we will be allowing for 15 minutes towards the end of the webinar to address as many of those questions as possible. If you didn't get an opportunity to post your question, or if you have any questions that come up during the course of the webinar, please refer to a box at the bottom of your screen called chat. If you click on that, it'll open up a chat box. If you can just make sure that the little blue toggle that says everyone is highlighted, that means that your question can be seen by us, the team that sit at the back end of this webinar that are our support, and then of course your fellow attendees, because I'm sure they might have similar questions and we could be addressing them at the same time. We will also be running a couple of polls. That's just to sort of establish who you are, why you're here, what future content you would be interested in. A poll question will pop up. You can answer the poll. Keith, we can't answer the poll, so you can just click it off on the red toggle, get it out of your way. But everyone else can answer the poll, and it's just, you don't have to, but if you do, we'd be very, very grateful. So Keith, I'm going to, let me nearly to hand over. Let me just quickly address the topics that we're going to cover today, and then we'll hand over to yourself. So the three broad topics that we have found that has come up the most, and this is questions that have been shared with me through email correspondence at the end of various webinars that we've hosted, talking about various topics. The first one that we're looking to discuss is cashing in your retirement annuity fund and presevation a pension where the members of such fund are no longer residents of the country. So if you are wanting to use your retirement fund to purchase a property overseas, or to live overseas, or to emigrate, what does that look like, and what is the opportunities there? The second topic that's important is the so-called immigration tax, which is different to the expat tax, which we will try to touch on as well, because I saw there were a few questions that came up there towards the end. And then, of course, the proposal it's on the table that will allow people under the age of 55 to access their retirement funds prior to retirement. These individuals would be living in South Africa and needing it for what reason? And this really came out of a COVID discussion. So let me hand over to Keith.
But thank you so much, Louise, for inviting me to share this webinar with you this morning. And hopefully I'm going to impart some knowledge to our attendees. By way of introduction, my name is Keith Peters. I am a legal advisor working for Old Mutual. I manage the legal advice for KZN and parts of Eastern Cape in respect of our distribution channels. And the core responsibility or functions that I do perform would be to provide advice of a legal, technical, and tax nature on all financial planning aspects, including retirement planning, estate planning, tax planning, to both advisors, brokers, and clients themselves. So hopefully this morning we are going to be imparting some knowledge. I know Louise did say she scoured the earth for the expert, and she couldn't find the expert, so she had to make do with me. So hopefully I'm going to be as good as as she'd like me to be. So Louise has asked me to concentrate on three aspects, but by no means is it going to be the only three aspects, because there are some questions that we did receive that I would try to answer them towards the end of the presentation or during the presentation if needs be. So to start off with, the first thing that we are going to be looking at is the commutation of RAs and preservation funds when a person ceases to be a resident of the country. So I think we need to do some history here and actually just take our minds back to before 1st of March 2021. Where you had a person who had actually emigrated and left the country, they could actually apply to cash in or commute their RAs or their preservation funds. And all that they needed to do was to provide proof of that immigration that they would have received either from the Reserve Bank or their new country of residence to the retirement fund administrator, which would then allow that fund administrator to make application via a tax directive to enable the member of that fund to commute or cash in their RA or preservation fund. So that was how the law was as at the 28th of February this year. And then on the 1st of March, we had some changes to that law. So what happened on the 1st of March this year? Very simple. If a person has now left the country and they want to actually access or commute that retirement fund, the RA or the preservation fund, then they have to actually prove to SARS that they've been a non-tax resident for an uninterrupted period of at least 3 years or longer before the fund administrator can then actually make application to actually have that particular fund commuted or cashed and paid out to the individual net of tax. So important here is to understand that we've now replaced the immigration reason with a tax reason in order for somebody to actually commute or cash in their RA or their preservation fund where they are no longer a resident of the country. Now, this could be of benefit to certain people who have left the country maybe years ago and they haven't actually formally emigrated from the country, but they still have perhaps an RA that they're contributing to in South Africa, or they have a preservation fund that they actually left in South Africa. All they would now have to show SARS is that they've been not paying tax in this country for at least 3 years in order for them then to make application to cash in that RA or that preservation fund. So the trigger event is now going to be the 3 years that they've no longer been a tax resident in this country. Importantly, when is it applicable from? The 1st of March 2021, but it doesn't mean you have to prove your non-tax residency from the 1st of March. If you've been a non-tax resident prior to the 1st of March, as long as it's 3 continuous or successive years, you can then make application to commute that RA or the preservation fund. Now, RAs are very simple to understand. Now, we know an RA is a vehicle that you make a monthly contribution to and that you will have access to when you reach the retirement age, which is normally 55. Preservation fund is slightly different. So I just want to explain what a preservation fund is. A preservation fund is nothing more than a parking facility when a person resigns or is retrenched or retires from employment, and they do not wish to actually use their retirement fund monies to purchase a monthly income. So what they will then do is they will preserve or park their retirement fund monies in a preservation fund. They are actually allowed prior to retiring from the preservation fund to access at least a certain amount as a one withdrawal. It can be a part withdrawal or a full withdrawal. What that then means is they're not allowed any further withdrawals from the preservation fund, and they would have to wait to retirement to access the balance, either by way of a monthly income or part lump sum and the balance as a monthly income. So now, what does this mean for people who are now living overseas? They have a preservation fund, they've done a one withdrawal, and the current law says you can't access any further monies until retirement. The law does allow people who've actually accessed one withdrawal from the preservation fund still to make application to cash in or commute the preservation fund itself, provided they satisfy the 3-year rule. So the one withdrawal is not going to prevent a person from accessing their preservation funds if they satisfy the 3-year rule. Does the new law apply to your normal pensioner provident funds? The simple answer to that is no. And the reason I'm saying that is when a person resigns from employment, and if they're contemplating emigrating, all they need to do is advise their fund administrator to apply to SARS for a tax directive whereby they're going to cash in the money and have the net of tax amount paid to their bank account, which then means they can make this as part of their settling in allowance, which they're allowed to take up to 10 million Rand with them. Obviously, they won't take more than that. They will pay a penalty agreed to with SARS, the Reserve Bank. So pension and provident funds are not impacted by this rule. It is only your RAs and your preservation funds where you have accessed one withdrawal. Now, I often get this question from clients and brokers as well. Does it apply to your living income plans? Now, the simple answer to that is no, simply because that living income plan is an income that you've purchased with your pension fund monies and you're now receiving an income from it. So if you've emigrated from the country, or if you're non-tax resident, rather, let me use that. If you're a non-tax resident and have been for the last 3 years, and you're still in receipt of an income from a living income plan, unfortunately, you cannot commute or cash that. What you can do, and I'm not advising this lightheartedly, you could look at accessing or doing the highest drawdown rate of 17.5%. In that way, you will try to get as much of the capital out to your new country of residence. Okay? But that needs to be taken in consultation with your advisor, because it's going to push you up into a higher tax bracket in terms of the income you are now receiving from South Africa. The only time that you can commute the living income plan is if the fund value itself drops to below 125,000. But SARS has added an additional proviso as at around about the 19th of Feb this year, where they've actually indicated if you have more than one living income plan with a life insurer or a fund administrator, combined, they must not be more than 125,000 in order for you to commute that. So I'm just going to remove this. So that is what you need to understand when it comes to the commutation of the RAs and preservation funds. If you're no longer a resident in the country, you have to prove 3 years non-tax residency. Now, from a practical perspective, question is, what documents are you going to be providing to SARS when it comes to you proving non-tax residency? The first document, and I think this can be a challenge, is to actually get a certificate of residence, which must not be more than 6 months old, and it has to be issued by the relevant tax authority of your new country of residence. So that's the first document you will have to provide to SARS. The second document you have to provide is a copy of your passport, which will actually indicate your exit and entry into the country itself. The third document, you have a choice of what you can provide. So first of all, you can provide your income tax assessments for the last 3 tax years from your country of residence, or you can provide confirmation of an active bank account for the last 3 years in your new country of residence, or you can provide proof of your residence for the last 3 years in your new country of residence, but it must not be older than 6 months. So it could be a rental agreement, it could be a utility bill, things along those lines. So the 3 things you need to provide: certificate of residence issued by the tax authority, copy of your passport indicating entry and exit into the country, and thirdly, one of 3 income tax assessments for the last 3 years, or you can provide proof of your residency, or you can provide a certificate confirming your bank account for the last 3 years in that country. Once that has been given to SARS, SARS is then going to code you as a non-tax resident, and they will then give you a letter or a document confirming your non-tax residency. That document, together with the documents I've already mentioned, will then have to be sent to the fund administrator, who will then complete the tax directive, submit to SARS in order to make sure that the correct taxes have to be paid before the money is eventually paid out to you in your new country. Obviously, there is always a requirement. You should have a blocked RAND account in South Africa, in which case the monies will be paid into your blocked RAND account. Failing that, you can then ask the relevant fund administrator or insurer if they would be amenable to having the monies paid into your new bank account in the country that you are residing in. I just want to also mention here, before we go on to the next topic, is the taxes involved. I think people don't realize that there are taxes involved when you are cashing in or commuting that RA or preservation fund. And unfortunately, we are taxed according to what we call the withdrawal tax tables. In terms of that withdrawal tax table, you only qualify for 25,000 as a tax-free amount. And the tax could range from anything between 0% to 36%, depending on the amount that you are cashing in or commuting. So that's very important for one to understand when it comes to taxes, which I'm going to be discussing when we talk about the next topic. The other aspect I also want to mention is about capital gains tax. When we actually terminate our tax residency, capital gains tax also comes into play. So why am I saying that? Because once you break that tax residency, there is now seen, or there will be seen, or a deemed disposal of all your capital assets that will be subject to capital gains tax. So your capital assets will include, for example, share portfolios, unit trusts, properties that you hold overseas. At this stage, it doesn't include South African property. It doesn't include personal use assets. It'll include all assets of a capital nature, which will then be subject to capital gains tax. So remember, whilst you're trying to access your retirement, your RA or preservation fund, by proving non-tax residency for the last 3 years, you're also going to be triggering capital gains tax as a byproduct. So I'm going to urge you, if you are considering emigrating, or if you are living overseas, perhaps and you're watching this webinar and you're contemplating accessing your RA preservation fund, please bear in mind the capital gains tax implications should you have capital assets that would be subject to capital gains tax once you cease your tax residency in South Africa. I'm going to pause here and just ask Louise if there are any questions that we do have.
So just we have a number of questions that we will address towards the end. So I'll try not to
towards the end.
Consume too much time. I just see the one thing that's come up here is your Preservation Fund Directive, the SARS code. Is it 319 or 3920? Maybe you know that offhand.
I'm going to be honest and say I'm not too sure what the code is.
We'll have to get back to you. Yes.
But it's very simple. One can actually go onto the SARS website and you type in SARS codes and you put in the code itself. It will indicate what that particular code is.
Fantastic. And then just my second question, we often understand that an individual's retirement fund or their retirement, they want to access that retirement fund that they've saved to purchase a property overseas. How does that process now be affected by a 3-year waiting period?
Unfortunately, the reality is that if they were earmarking those proceeds to purchase a property overseas, because of the 3-year rule, they're only going to have access to those monies after they've proved 3 years of non-tax residency. So it's a bit of, I would say, a catch-22. They may want the property, but the monies are tied up here. There isn't anything that they could do to access the monies any faster. I'm not too sure if there would be any arrangements that they could enter into between themselves and the seller to defer the payment of the purchase price till they receive the monies, or enter into a rent to buy if that is allowed in the country of residence. So not a very easy question to answer, simply because they wouldn't have the access to the monies until they satisfy the 3-year rule.
Okay, let's keep going, because I have a few more questions, but I'd like to sort of try and stack those towards the end, and I'd like us to get through the 3 points first. So perhaps we can carry on to our next topic, which is our immigration tax, or our so-called immigration tax.
Lovely. Okay, so just before I want to go into immigration tax, I just want to mention something. When it comes to proving non-tax residency, the income tax actually allows us to follow 2 tests. So one is the ordinarily resident test, and the Act provides us guidelines as to what you can use to prove that you are either ordinarily resident or not ordinarily resident. So things like, where is your normal place of abode? Where do your personal belongings are housed? Do you have political, cultural affiliations in this country? They would look at your family, your children, their schooling, etc. So there's quite a number of factors that one can use to either prove or disprove that you're ordinarily resident in the country in order to prove your tax residency status. The other test is a physical presence test, and that is very factual. If you're in the country for more than 91 days in a year of assessment, and if you've been in the country for the last 5 years, more than 91 days in each of those years, and in aggregate over those 5 years, if you've been in the country for 915 days, then you'll be seen as a resident. So one can use that, because I often get the question is, how do I prove non-residency? The income tax clearly gives you an indication of how to prove non-residency. To move on to the second topic, and I think it actually flows very nicely from what we've been talking, because the Draft Taxation Law Amendment Bill of 2021 introduced the so-called immigration or exit tax that taxpayers were concerned about and how it would affect them. So I think it follows on, like I said, very neatly from what we are talking. So to start off with, in terms of the Income Tax Act itself, where an individual or taxpayer receives a lump sum or a monthly pension from a retirement fund in respect of services rendered in South Africa, then the lump sum or that monthly income itself will be taxed in South Africa. Okay, so we follow a worldwide sort of taxation wherever your assets are or income is, and you're a South African resident, we're going to be taxing you on that. Now, the question arises, where somebody ceases to be a tax resident in South Africa, okay, the lump sum itself and any income that they may be receiving could potentially be taxed in their new country of residence and not South Africa if there is a double taxation agreement between that country and South Africa. So what is a double taxation agreement? It's a tax treaty actually signed between South Africa and various countries to make sure that a particular individual or taxpayer is not going to be paying double taxes on the same lump sum or income. So actually it's to protect consumers from paying unnecessary taxes going forward. So when a person now becomes a resident of a country that South Africa has a double taxation agreement with, there could arise the possibility that the lump sum payable from this RA, once they've proved that they're no longer a tax resident, could actually be taxed in that country and not South Africa. So suddenly, South Africa's revenue services is losing out on possible inflows because that lump sum is now going to be taxed in that other country. Also important to note here, remember that the person who's now left the country would have been receiving tax deductions for the contribution that he or she made to that RA whilst he or she was in the country and still a member. So one could argue, perhaps from a SARS point of view, it's a bit unfair. They've given you the tax benefit and suddenly they're not allowed to actually tax the lump sum when you are taking the monies out. That is now being moved to the person's new country of residence. So the proposed changes, or let me call the proposals. And the reason I'm saying proposals is because commentary is still being invited by National Treasury, by interested parties to give input on this particular proposal. So the proposal is that when a person ceases to be a tax resident, then the tax will be calculated on the fund value at that stage according to the relevant and prevailing tax tables itself. So in most instances, it's going to be the withdrawal tax tables that will be applicable. Now remember, all that's happening here is a calculating the tax, but the tax is only going to be payable when the individual actually receives the monies from the retirement fund. Equally important to remember is that interest will be levied on that tax calculated, and it will accumulate to when the person does eventually receive the monies. So let me put this very practically for you. We have a client, or let me say we have an individual who's now moved and living in the UK. He or she hasn't formally emigrated. They do have an RA in South Africa, which they want to access. They do understand they have to prove 3 years non-tax residency. In year one, they're able to prove non-tax residency because they're now a fully fledged taxpayer in the UK. SARS has accepted that they're no longer a tax resident. However, they still have 2 years to go in order to access the money. What SARS is saying, in that year one, you cease to be a tax resident. We're then going to calculate the tax payable on your retirement fund. It won't be payable now because you don't have access to the funds. It's going to be deferred to the end of the 3 years when you have completed the 3-year rule. come the end of the 3 years, the tax directive is applied for. The tax is then again calculated on what the fund value is at that stage, and a credit is given to the individual for the tax that was calculated in year 1. Okay, so all SARS is doing here is they're working the tax upfront the minute you prove or you show you're no longer a tax resident, but deferring payment of it to when you fulfill the 3-year rule itself. So that's what this whole immigration exit tax law is all about. Yes, there are some issues with that. One of them is the fact that you're calculating the tax now, but it's only payable when the individual receives the money. And in addition to that, you're slapping interest on the tax from year 1. So you're kind of putting the person at a disadvantage from a cash flow point of view. That's the one issue. The second issue is perhaps the country of residence. So in my example, the UK may also want to tax that lump sum when it is paid out to the individual. So it's going against the spirit of the double taxation agreement, where you're actually now taxing the person twice. And the third issue that has been risen is in the case of failed immigrants. So somebody may have ceased to be a tax resident of South Africa, but they may not meet the requirements to become a fully fledged UK citizen, which means they may have to return back to South Africa. What happens to that so-called accrued calculation? Is the person still liable for it, even though he's now reverted back to being a South African resident? So those are some of the issues that have arose. That's the reason I'm saying, rather than us panic about this tax, let's wait for National Treasury and SARS to put this in an act perspective so we know exactly where we stand with that there. I've kept it very briefly because I do believe that you should be consulting with your financial advisor when it comes to matters of this nature in order for you to get the best holistic advice possible. And then the last thing I do want to touch on before we go to the questions is this whole question about access to your retirement funds before age 55. So if memory serves me correct, I think Tito Mboweni in his medium-term budget policy statement around about August or September mentioned something about allowing people to have access to their retirement funds before age 55. I think most people assume that this was as a response to the struggles that people may have with COVID from a financial perspective, but National Treasury actually said the stemmed before that. They did notice that people were struggling financially, and they want to see how best they can allow people access to these retirement funds before age 55. So, few things that we have to understand. First of all, National Treasury, together with government, does not want people to stop contributing to retirement funds. At the end of the day, with all the tax breaks provided, and with the fact that we don't see the social old age pension increasing that much year on year, they want people to take responsibility for their own retirement planning. With that in mind, remember this year, this change is going to take some time. They did propose 2022, but remember the current rules of your retirement funds do not allow pre-retirement withdrawals. So you're going to have a law change. You're going to have individual retirement fund trustees meetings for them to pass resolutions and change the fund rules in line with the change in legislation. So how would this proposal work? So government is saying from the supposed effective date, let's assume 1st of March 2022, we're going to have 2 buckets in respect of future contributions. So bucket 1 will be where you are able to access whatever you've contributed together with the growth after the effective date as a lump sum. Bucket 2 is going to be all your contributions that you've made together with the growth that you are compelled to use to buy yourself a monthly income. In respect of bucket 1, it does not mean you're going to have access to all the monies that are there. There would be limits, and furthermore, you've also got to prove certain circumstances that warrant you to have access. So National Treasury is talking about extraordinary circumstances, extraordinary financial circumstances. So it's not going to be available for everyone. You've got to actually prove that you are in dire financial need for you to access it. The important thing is your current fund value in your retirement funds will not form part of these buckets. So whatever you've contributed up and until the effective date and the growth thereon would still be administered according to the current rules. So if it's a pension fund, you're allowed to take 1/3 in cash on retirement, 2/3 to buy yourself a monthly income. So that's very important to note. It's only going to be in regards or in relation to contributions made after the effective date itself. Okay. Louise,
Thank you so much.
I'm going to stop there and perhaps we can look at some of the questions. I'm not too sure about our time.
Yes, no problem. Okay, so we'll press on. So the first, I'm just going to grab a question that's sitting in our chat box. If I earn a monthly salary in SA but live permanently in Mauritius, which I think is a number of people are looking at, and do my work remotely in Mauritius, where will I be taxed?
So first and foremost, South Africa's tax authorities actually, when it comes to non-residents, we work on a source-based taxation. So essentially what we will do is we say you earn the income here, we're going to be taxing you here. However, there is a section in the Act that allows you to make application to SARS to actually have your income taxed in your country of residence. So there is an opportunity for you to have the income tax there as opposed to South Africa. I would encourage you to consult with your tax advisor who will be able to assist you when it comes to that application.
Okay, great. Thank you. Yeah, because the taxation laws in Mauritius are somewhat gentler than what they are.
I don't think France is going to be all that comfortable, especially if the source of the income is South Africa and there is no reciprocal tax being paid or charged in Mauritius to actually allow no tax to be paid.
Okay, so pressing on. So this question is maybe a little tricky to answer. So it says, how will existing pensioners be affected by new legislation? So we've spoken about three different areas here. What I suppose that the question is that would the same rules apply if you have already retired, although you might already have had one withdrawal?
So again, if you are leaving the country, the same rules will apply. Unfortunately, you will have to prove 3 years non-tax residency if you still have an RO preservation fund in place. If you've retired, the chances of you having one of those vehicles in place is very remote because you would have retired and purchased yourself a monthly income. So if you're going to be leaving the country, unfortunately, you can't commute the monthly income. You would have to continue receiving it in your new country of residence.
So in the case of Mauritius, if you are immigrating and retiring to Mauritius, and you need to prove a 1,500 USD income on a monthly basis, or 18,000 over a year, this could be coming from your retirement income in South Africa being then deposited into your Mauritian bank account. My next question here would be, what is the penalty if you withdraw from a pension fund 2 years early?
Okay, there would be no penalties. Now, I'm not too sure on the circumstances that we're referring to, which circumstances. Remember, when we're talking withdrawing, I'm making the assumption the person is resigning. If it is what we call a defined contribution fund, there are no penalties because whatever your fund value is as a date of resignation is what you're going to be receiving. If it's a defined benefit fund, there could be penalties because a defined benefit fund, the fund itself actually pays out the pension based on your salary and your years of service. So that's where penalties could come in, where you have a defined benefit fund. We have very few defined benefit funds in South Africa. Most of them are government or parastatals. The most common one is your GEPF, which is a defined benefit fund. But if I'm talking private sector funds, no penalties because most of them are defined contribution funds.
Okay, thank you. So next question, I would like to know if it's worthwhile making my maximum allowable contribution to my RA considering the new pension tax legislation.
Okay, so it is something that one has to discuss with their financial advisor. But to give you a very generic answer, we are allowed to contribute 27.5% of the greater of our taxable income or remuneration to any retirement vehicle of our choice to get the maximum tax deduction, which means that we will be paying less taxes year on year. The second point you have to ask yourself, and which I think is more important, is how much do you need to retire on? That is actually going to dictate or determine the amount that you should be contributing. I think we get fixated with the tax so much that we forget that what's more important is working out how much we actually need to retire with. So for me, that is more important. And I would encourage the person who asked the question to consult with their advisor to make sure that what they're contributing is going to be beneficial when they do retire.
Another question, though possibly a little bit difficult to answer. When can a person migrate financially from SA? So I suppose to me that seems to be a bit sort of based on your own journey.
Okay, so thanks for asking the question because I meant to mention it because before 1st of March, you were allowed to prove financial emigration in order for you to cash in your RA or preservation fund. The concept of financial immigration no longer exists in our law as of the 1st of March 2021. So financial immigration was an easier option as opposed to formal immigration. You would still have citizenship in South Africa, but you would be able to cash in your RA and preservation fund, but it's no longer a concept in our law.
Thank you. Okay, so what are the implications to the estate if one's money has emigrated already, but due to various reasons, one has not managed to emigrate physically as yet?
I'm going to, so the question is regarding estate planning. And we need to bear in mind that when it comes to a person who's passed away and they have assets in South Africa, those assets will be subject to various taxes in South Africa, including estate duty and capital gains tax, even though the person is no longer a citizen or resident of this country. Obviously, if they are going to be paying similar taxes in their new country, then a credit will be passed or given in respect of the taxes that they've paid here. So it hasn't answered the question fully because I'm just trying to understand. The person has said they haven't physically immigrated. They have assets in South Africa, but they're going to immigrate.
They're saying that if one's money has emigrated already, so they've financially emigrated, but they themselves physically haven't emigrated. Okay. I think what we'll do is, what we can do is rather, I will direct that question offline and maybe ask more information.
Very quickly for you in a minute. So when they say their money has financially immigrated, now, number one, there's no financial immigration. I'm assuming they have offshore investments. They haven't physically immigrated. They're still here. When they pass away, we will consider their worldwide assets in the administration of their estate. Their worldwide assets will be subject to estate duty in South Africa.
Thank you. Okay, this is a bit of a long question. So what if an advisor lives abroad but still maintains a practice in SA? The way I see it, contracts with insurers are held with a registered IFA company registered in SA, licensed with the FSCA, income taxable in SA. This might be a second question. What if there is dual income, FSCA approved for SA residents and non-FSCA approved for non-resident business abroad?
Okay, it's a very long question because
yes.
I think it has various parts to it, because they're talking about the financial advisor living overseas. Number one, in respect of that, as long as the financial advisor has informed the FSCA, the umbrella body that regulates financial advisors, that they're still a registered financial advisor in South Africa, but they're living overseas, then I don't see there being a problem in them still managing clients in South Africa. Remember, we're working remotely. We do have, All Mutual, a financial broker, independent, who's living overseas in the UK, but he still looks after his clients in South Africa. The other part of the question, I'm going to have a look at it and reply offline, because it's talking about income tax, etc.
And there's a few more questions. How much is one allowed to send offshore annually, and is this subject to expat tax?
Okay, so as a taxpayer, if you're 18 years and over and you're a registered taxpayer, you're allowed to invest up to 10 million Rand per year overseas. In addition to that, you're allowed a 1 million Rand discretionary allowance when you travel as well. Which is very generous, because when I first started All Mutual almost 16 years ago, you were only allowed to invest 750,000 over your lifetime overseas. We now move to 10 million Rand per year. So that's a very short answer, 10 million Rand per year.
And then what is expat tax?
Okay, so I think what they're referring to there is the tax where you have people who are working overseas. So by way of example, we might have somebody who's working in Dubai, but they're still a resident of this country. They're earning income there. The way the law stands, it states that if you are outside the country for more than 183 days, and 60 of those days are continuous, and you earn less than 1,250,000 in Dubai, you will not pay tax on that. But the minute you earn more than 1,250,000 and you satisfy those days that I've mentioned, you will be taxed on any amount in excess of 1,250,000. That 1,250,000 includes all benefits by way of salaries, bonuses, fringe benefits like flights, house accommodation, etc. All that is included in your 1,250,000. And generally, you'd find that most people who are working overseas in those so-called tax havens, or perhaps on cruise liners, they could possibly be earning more than 1,250,000 if you take into account all the additional benefits. So then they are subject to that expat tax.
We are now at our 45, just over our 45-minute mark. I still have a few more questions. Perhaps we will address those offline, as I'm sure we've sort of penciled out this time, and folks need to get on with their days. I just want to say thank you so much to you, Keith, for taking your time out today to answer these questions and to share information with us. This is so valuable, and it gives opportunity for folks to access information, go through the recordings, which will be shared with everyone, and then make a more educated decision or enter into a negotiation and discussion with their advisors, understanding the content a little bit better and understanding what they're trying to achieve a little bit better. So thank you so much for joining us, and to everybody who's put their time aside this morning to join us on another Expert Insight. We appreciate all your support. We hope that you find this information beneficial to you, and please feel free to send any email to me if you would like any other topics covered, if you would like to be introduced to Keith or any of the members of Old Mutual Advisors teams. And then, of course, next week we'll be tackling another topic. So we hope that you stay tuned and continue with us on our Expert Insight series. Thanks so much again. And Clem, could you put our video on for us?